They said it was over. They said the crash was the beginning of the end. But this morning, something happened that changed everything. Look at your screen right now. Silver isn't trading at $70. It's not even trading at $75. We are witnessing something that hasn't happened in over a decade. The price just broke through resistance that held for years. And if you blinked, you missed the most important financial signal of your lifetime. While you were sleeping, the world shifted. While the headlines screamed about crashes and fear, a silent war started. Not with bullets, not with bombs, but with something far more powerful. Capital. Massive, institutional, unstoppable capital. The kind that moves mountains. The kind that rewrites price charts. The kind that doesn't care about your technical analysis or your resistance levels. Here's what they're not telling you on the mainstream networks. Here's what the analysts won't say because they're terrified of being wrong. This isn't just another rally. This isn't just another squeeze. What we're watching unfold right now is the early stage of a complete market reset. A repricing event so violent, so unprecedented, that by the time the average investor understands what happened, it will be too late. Three forces just collided. Three unstoppable mathematical certainties that converged at the exact same moment. And when these forces collide, they don't create ripples. They create tsunamis. The first force, geopolitical chaos that just made silver a weapon. The second, a vacuum so powerful it's sucking physical metal out of Western vaults at a speed that defies logic. The third, the smartest money on the planet just realized they're on the wrong side of history. But here's the part that should terrify you or excite you beyond measure. We're only in hour one of day one. The explosion you saw this morning? That was just the fuse being lit. The real fireworks haven't even started yet. And in the next few minutes, I'm going to show you exactly why the price you see on your screen right now will look like a bargain by Friday. Are you ready to see what they don't want you to know? January 5th, 2026. Remember this date. Because this is the day the market broke. Not the stock market, not the bond market, the silver market. And when silver breaks, it doesn't crack quietly, it explodes. Let me take you back 12 hours. Sunday night. Most of America was asleep. Most traders were offline. The exchanges were dark, but in the shadows of the electronic markets, something was brewing. The Globex system, the 24-hour trading network that never sleeps, was about to witness violence. At precisely 6 p.m. Eastern Time, when the futures market reopened, silver didn't tick up. It didn't climb. It teleported. From $71 straight to $73 in less than 60 seconds. A $2 gap. Instant. No trades in between. Just a void where the price should have been. Why? Because over the weekend, while you were living your life, the geopolitical landscape shifted. News broke that most people scrolled past. Headlines that seemed like just another story. But the smart money, the people who move billions before breakfast, they didn't scroll past. They read between the lines. And what they saw made them hit the buy button with everything they had. Venezuela, that's the word that changed everything. Reports emerged of U.S. military operations in South America. The official story, regime change. The real story, resources, oil, minerals, control. And when the world's superpower makes a move like that, it sends a signal that echoes across every commodity market on the planet. It says one thing loud and clear: secure your assets or lose them. But here's what makes this different from every other geopolitical event you've seen. This isn't happening in the Middle East. This isn't happening in some distant war zone that feels abstract. This is happening in Latin America, right next door, in the region that produces a quarter of the world's silver, in the backyard of the mining operations that feed the entire Western industrial complex. Do you understand what that means? When uncertainty hits the region that supplies your silver, the market doesn't wait for confirmation. It doesn't wait for official statements. It prices in the worst case scenario immediately. And the worst case? Supply disruption, export restrictions, resource nationalism, countries locking their vaults to protect their strategic metals. The smart money saw this coming 12 hours before you woke up. They placed their orders. Market on open. Buy at any price. Get me in before everyone else figures it out. And that's why silver gapped. That's why there were no sellers. Because who wants to be short a strategic metal when military operations are active? Nobody with a functioning brain. But the gap did something else. Something brutal. It trapped the bears. Every trader who went home Friday night betting on a pullback, betting on weakness, betting they could buy back cheaper on Monday morning, just woke up to a nightmare. They were short at 71. The market opened at 73. They were instantly underwater, losing money while they slept. And now they have a choice. Take the loss or wait and hope it comes back down. Spoiler alert, it's not coming back down. Let me show you something that will make your blood run cold or hot, depending on which side of this trade you're on. Right now, at this very moment, there are two silver markets operating on planet Earth. Not one, two. And they are telling completely different stories. In New York, silver is trading at $75.60. That's what you see on your screen. That's what the news reports. That's what everyone thinks is the real price. But in Shanghai, at the exact same moment, silver is trading at over $80. Stop. Read that again. $80, not 75, not 76, 80, a $5 gap between the same metal on the same day at the same time. In a normal market, this gap shouldn't exist for more than 5 seconds. Arbitrage traders, the sharks of finance, should close it instantly. Buy in New York for 75, ship it to Shanghai, sell it for 80, free money. But the gap isn't closing, it's widening. And that tells you everything you need to know about what's really happening beneath the surface of this market. China isn't just buying silver, they're devouring it. Their demand is so ferocious, so insatiable that even with metal flowing in from every corner of the globe, the price keeps climbing. They're not speculating, they're not day trading, they're building solar panels, electric vehicles, 5G infrastructure, smart cities. Everything that powers the future runs on silver, and they need it now. Here's the brutal reality that Western investors don't understand yet. Every single day that this $5 gap exists, physical silver is being drained from London and New York vaults and shipped east. It's not coming back. Those bars aren't going to magically return when the rally is over. They're being consumed, turned into products, embedded in technology, gone forever. The COMEX, the futures exchange in New York where official silver trades, is bleeding inventory. Not slowly, not gradually, rapidly, violently. Because every refiner, every bullion bank, every dealer is faced with the same math problem. Sell to a Western buyer for 75 or sell to a Chinese buyer for 80? Where does the metal go? East, every single time. And here's what makes this absolutely catastrophic for the paper market. The price you see, that 75.60, it's not measuring reality anymore. It's measuring the paper contracts trading in New York. It's measuring bets and speculation and derivatives. But the real price, the price where physical metal actually changes hands, is $80, maybe higher. The thermometer is broken. The room is on fire, but the temperature gauge says everything is fine. Shanghai is the real market now. New York is just the echo. Why is China paying $80? Simple, because they have to. It's January. Production quotas for 2026 just kicked in. Factories across Jiangsu province are ramping up solar panel manufacturing for spring installation season. They need silver paste. They need it in tonnage. And if they don't get it, the factories stop. Workers go home. Contracts get canceled. The cost of not having silver is higher than any price they have to pay for it. This is what inelastic demand looks like. This is what happens when an entire industrial economy depends on one metal. They don't care about charts. They don't care about resistance levels. They care about survival. And survival capital always beats speculative capital. So while day traders in New York are drawing lines on screens, industrialists in China are writing checks. Big checks, blank checks, whatever it takes. And every dollar they spend pulls the global price higher. The magnet is on. And New York is being dragged toward 80, whether it wants to go there or not. But wait, it gets worse. Or better, depending on your position. Remember New Year's Eve? Remember when silver crashed to $70.50? That wasn't an accident. That wasn't panic selling. That was deliberate, calculated, executed with surgical precision by the biggest banks on Wall Street. They needed to smash the price. Not because they hate silver, not because they wanted to hurt you, but because of something far more mundane: regulation. At the end of every year, banks have to report their risk exposure to regulators. And if silver is trading at $75 and you're short millions of ounces, your risk profile looks ugly, real ugly, the kind of ugly that triggers phone calls from compliance departments. So what did they do? They dumped. Hard. They sold thousands of contracts in minutes. They overwhelmed the bid. They drove the price down to 70. They took their screenshot at midnight. They sent it to the regulators with a smile. Look, see? We're not exposed. Everything's under control. The plan was beautiful. Crash it on December 31st. Clear the books. Then spend January slowly, quietly buying it back at cheap prices. Cover the shorts at 71, 72, maybe 73 over the next 2 weeks. Easy, clean, profitable. But then Venezuela happened, and Shanghai happened, and their perfect plan turned into a death trap. The banks are now sitting on short positions that they sold at $70, and the market just reopened at $75.60. They're losing money on every single ounce. $5 per ounce times millions of ounces equals hundreds of millions in losses. And it's only Monday morning. This is what we call being offsides. Catastrophically offsides. They sold at the bottom. And now they have to buy at the top. The market isn't giving them a slow, orderly chance to cover. It's running away from them. Every hour they wait, the price climbs higher. Every hour they hesitate, their losses compound. So what are they forced to do? Buy. Not because they want to, not because they believe in silver, but because their risk models are screaming at them. Their algorithms are flashing red. Their bosses are asking questions. They have no choice but to become chase buyers. paying any price, taking any offer. Just get us out of this position before it kills us. And every buy order they place pushes the price higher, which forces the next bank to panic, which creates more buying. It's a feedback loop, a doom spiral. For the shorts, anyway. For the longs, it's rocket fuel. But here's the part that should terrify every bank trader right now. $75 wasn't just a number. It was the number, the line in the sand, the resistance level that held the market down for all of December. They built a wall there. Thousands of sell orders stacked at 75 to cap the rally. This morning, that wall got obliterated. And when a major resistance level breaks, especially one that held for weeks, it triggers something mechanical, automatic, unstoppable, stop losses. Every short seller who thought they were being smart, who thought they were managing risk, had stop loss orders sitting just above $75. Insurance policies. If this trade goes against me, get me out. Well, guess what? The price crossed 75, and every single one of those stops fired at once. A stop loss on a short position is a buy order. Forced buying, panicked buying. Buying at market price no matter what market price is. And when thousands of stops hit simultaneously, the price doesn't tick up. It spikes, violently, vertically. The banks built their own execution chamber. Their defense mechanism became the weapon that killed them. Right now, there's a prisoner's dilemma playing out in the trading rooms of Wall Street. Imagine 3 big banks, all short silver, all losing money, all needing to cover. But here's the problem. If Bank A covers first, their buying pushes the price up, which makes Bank B and Bank C's losses even bigger. So who moves first? The first one to panic gets the best price. The last one to panic gets the worst price. So the incentive is to panic first, to throw your competitors under the bus to save yourself. We believe that's exactly what happened this morning. One bank blinked, one bank folded. They hit the buy button. They drove the price up 3%, and they left their competitors holding the bag. This is how cartels break. This is how suppression schemes fall apart. When the coordination dissolves and it becomes every bank for themselves, the price goes to its natural level, and the natural level is much, much higher than 75. The trap is sprung. The banks are bleeding. And the buying pressure is only beginning. Now we need to talk about the money that matters, the money that moves mountains, the money that doesn't trade on emotion or technical analysis, the money that operates with one single directive: allocate capital for the long term, pension funds, sovereign wealth funds, university endowments, insurance companies, the giants of institutional finance managing $50 trillion in assets. And starting today, Monday, January 5th, they're deploying capital for 2026. This is a documented phenomenon in the investment world. Every January, the allocation committees meet. They review the prior year's performance. They adjust their models. They rebalance portfolios. And they make strategic decisions that will govern trillions of dollars for the next 12 months. For 40 years, these institutions followed one simple rule: 60-40. 60% stocks, 40% bonds. Ignore commodities, ignore gold, ignore silver. They thought inflation was dead. They thought bonds were safe. They thought the old playbook would work forever. But 2025 shattered that illusion. Bonds lost money, stocks were volatile, inflation ate their returns alive. Pension funds across America are now underfunded. They promised retirees 7% annual returns. They delivered 3%. The gap is widening, the pressure is mounting, and the investment committees are scrambling for solutions. So in December, behind closed doors, the meetings happened. The strategy shifted. The memos went out. We need hard assets. We need inflation protection. We need real returns in a world where paper promises are failing. Enter silver, not as a speculation, not as a trade, but as a strategic allocation, a solution to the problem that's keeping pension fund managers awake at night. Let me show you the math that's driving this decision. The California Public Employees Retirement System, CalPERS, manages over $500 billion. They recently announced a new investment approach called the Total Portfolio Strategy. Instead of rigid asset buckets, they're targeting specific themes, and one of their biggest themes, climate solutions. What's a climate solution? Solar farms, electric vehicle infrastructure, power grid upgrades, smart grid technology, energy storage systems. Every single one of these requires massive amounts of silver. When CalPERS allocates billions to climate solutions, they're indirectly creating enormous demand for physical silver. Now scale that across the entire pension fund industry. If global pension funds move just 0.1% of their assets into this sector, that's $50 billion of new buying pressure hitting the market. But here's the problem. The entire annual mine production of silver is only worth $25 billion. Do you see the math problem? They're trying to buy 2 years of global production all at once. It doesn't fit. You cannot pour $50 billion into a $25 billion market without moving the price. There isn't enough metal. The price has to rise until that $50 billion buys a smaller quantity. It's not speculation, it's physics. But there's something even more important you need to understand about institutional money. It's different from trader money, completely different. When a hedge fund buys silver, they're in and out. They buy today, sell tomorrow. They chase momentum, they use stops. They're hot money. When a pension fund buys silver, they're making a strategic decision for the next 5 to 10 years. They buy the position. They lock it in the vault. They sit on it. They don't day trade. They don't panic sell. They remove the float from the market permanently. Every single ounce that a pension fund acquires this week is an ounce that will not be for sale at $80, not for sale at $90, not for sale at $100. It's sequestered, gone, joining the silver in solar panels and electronics that will never return to the market. This creates what we call a ratchet effect. The price goes up on buying, but it doesn't come down on selling, because there is no selling. The available inventory shrinks every single day that institutions are active. We're moving from a liquid market to an illiquid market where the only sellers left are the desperate. How do pension funds actually buy silver? They don't walk into a coin shop. They don't buy futures contracts. They buy ETFs, exchange-traded funds, SLV, PSLV, SIVR, the paper products that are supposed to be backed by physical metal. Here's how it works. When a pension fund clicks buy on $100 million of SLV shares, something mechanical happens behind the scenes. The authorized participant, usually a big bank, has to create new shares. And according to the legal prospectus, according to the rules they agreed to, they must deposit physical silver into the ETF vault to back those shares. They have 48 hours, 2 days to find the metal, real bars, real weight, real silver sitting in a real vault that auditors can verify. This isn't optional. This is the law. This is what makes an ETF different from a futures contract. So when CalPERS buys 100 million of SLV today, JP Morgan, or whoever the authorized participant is, has to scramble. They have to source physical bars. But where? The London vaults are running dry. The Shanghai Arbitrage has been draining inventory for weeks. The COMEX warehouses are at multi-year lows. Where does the metal come from? They have to beg. They have to lease from central banks. They have to offer premiums to refiners. They have to pull bars from other accounts. They turn the ETF market into a vacuum cleaner, sucking up every available ounce just to satisfy the creation demand. But here's the nightmare scenario that nobody's talking about yet. What happens if they can't find the metal? What happens if JP Morgan gets the order to create 10 million new SLV shares and they physically cannot source the silver to back them? Two options. Option one, the share price disconnects from the net asset value. The premium blows out. People start asking questions. Auditors get nervous. Option two, they create the shares anyway and hope nobody notices. Paper silver backed by nothing but a promise and a prayer. We're watching the vault inventory numbers closely this week. If we see massive inflows into silver ETFs, but the reported vault holdings don't increase proportionally, we'll know exactly what's happening. We'll know the banks are issuing paper they can't back. And when that truth comes out, when the auditors dig in, when the discrepancy gets exposed, that's when this market goes supernova. The pension funds are the whale that the banks cannot control. They're too big, too slow, too methodical. They don't react to price, they react to allocation targets. And right now, their allocation targets say buy silver. So they buy. And they'll keep buying until their quota is filled, regardless of whether the price is 75 or 85 or 95. But there's another psychological force at play here, performance chasing. Imagine you're a fund manager. You manage a $10 billion portfolio. You wake up Monday morning, you see silver up 5%. You check Tuesday, silver up another 4%. You look at your competitor's fund. They own silver. Their returns are crushing yours. What do? You panic. Not because you believe in silver, not because you understand the fundamentals, but because you're getting left behind. Your clients are asking questions. Your boss is asking questions. Your bonus is on the line. So you abandon discipline. You chase performance. You buy what's working. You buy silver. And your buying pushes the price higher, which makes it look even better to the next fund manager, who then also has to buy. It's a momentum spiral. Buying creates more buying. The higher it goes, the more attractive it becomes. This is how manias are born, not from fundamentals, not from logic, but from fear. The fear of missing out, the fear of underperformance, the fear of being the only one who didn't see it coming. The quant funds are piling in too, the algorithms, the robots that manage billions based purely on mathematics. They don't read headlines. They don't care about Venezuela. They just calculate sharp ratios and volatility patterns and momentum indicators. And right now, every single technical signal they're programmed to follow is screaming one word: buy. We're watching a convergence of fundamental flows and technical flows and psychological flows all hitting at the exact same moment. And there's nobody left to sell except the short sellers who are already drowning. The pension funds have arrived, the institutional wave is here, and it's only Monday. Let's talk about what comes next, because understanding where we've been means nothing if you don't know where we're going. The price is 75.60, the breakout is confirmed, the resistance is broken, but this is just the beginning of the journey. Where is silver headed? What's the next target? When do you take profits? When do you hold? These are the questions that separate survivors from casualties in a vertical market. Look at the chart. Really look at it. We just broke 75. That was the ceiling that held us down for weeks. Every rally in December died at 75. The banks built a fortress there. Sell orders stacked like bricks. But this morning, we smashed through it like it was paper. When a major resistance level breaks, especially one that held that long, it doesn't just crack. It becomes support. The ceiling becomes the floor. 75 is now the new baseline. We're not going back there unless something catastrophic happens. And I mean truly catastrophic. So where's the next stop? The next major technical level is $85. This is the 1.272 Fibonacci extension of the multi-year base we built from 2022 to 2025. The algorithms, the trading bots, the quant funds, they're all programmed to chase price to this level. It's mathematical, it's predetermined, it's baked into the code. Between 75 and 85, there's very little resistance. It's what traders call an air pocket. There are no major psychological barriers, no heavy sell walls, nothing to slow the momentum. When price enters an air pocket, it doesn't climb, it levitates. I expect we'll see $80 by Wednesday. Maybe sooner if the pension fund buying accelerates. I expect 85 by Friday. Maybe by Thursday if the shorts keep panicking. This isn't hopium. This isn't wishful thinking. This is reading the order flow. This is understanding market structure. But here's where it gets interesting. At 85, expect a war. That's where the first wave of profit taking will hit. The early buyers, the ones who got in at 65 or 70, they're going to start cashing out. They're going to lock in their gains. They're going to take their 50% returns and walk away. The banks will try to short again. They'll see 85 as too high, too fast. They'll think it's overextended. They'll think they can cap it there and ride it back down. They're going to try the same playbook they used at 75. And they're going to fail. Again. But not before they create turbulence. So here's the play. Do not buy the breakout at 85. Do not chase it as it pierces through. Wait. Be patient. Let the profit takers sell. Let the banks throw their short positions at it. Let the price pull back. And then, when it retests 85 and holds, when it proves that 85 is now support, that's when you add to your position. Buy the dip after the breakout is confirmed. Not before. Not during. After. But let me tell you something that's even more important than timing your entry. Let me tell you something that will determine whether you actually make life-changing money from this move or whether you just watch it happen and end up with nothing. You need to understand what you're selling for. Most people think in dollars. They think, I'll sell silver when it hits $100 and I'll have all this cash and I'll be rich. But they're not thinking clearly. They're not asking the right question. If silver goes to $100, what does that tell you about the dollar? It tells you the dollar's dying. It tells you purchasing power is evaporating. It tells you that the thing you're selling into is worth less than it was when you started. So why would you want more of it? You don't sell silver for dollars. You sell silver for real assets, for land, for businesses, for gold, for things that hold value when currencies collapse. That's the end game. That's the exit strategy that actually works. Here's the metric I'm watching. The gold to silver ratio. Right now it's sitting around 58 to 1. That means 1 ounce of gold buys 58 ounces of silver. Historically, this ratio compresses during silver bull markets. It tightens. Gold and silver move closer together in value. My first target is 30 to 1. When the ratio hits 30 to 1, I'm swapping 20% of my silver stack for gold. Not for dollars, for gold. I'm trading the volatile metal for the stable metal. I'm locking in gains in an asset that has held value for 5,000 years. My second target is 15 to 1. Historically, that's where silver bull markets peak. That's where the ratio bottoms. When we hit 15 to 1, I'm swapping everything. I'm converting my entire silver position into gold. Tripling my gold stack, retiring. We're nowhere close to that yet. We have a long way to go. But you need to have this plan written down now. You need to have it tattooed on your brain. Because when the mania hits, when your friends are screaming at you to buy more, when the price is going vertical and FOMO is eating you alive, you need a cold, hard rule to force you to sell. Without a plan, you'll ride it up and ride it back down. You'll watch your gains evaporate. You'll become a cautionary tale. Don't let that be you. Now let's talk about survival. Because making money and keeping money are two completely different skills. And in a market moving this fast, with this much volatility, with this much emotion, survival is everything. If you're trading silver on leverage right now, if you're using margin, if you're playing with futures or options with high delta, you need to hear this. You are in danger, serious danger, not from the fundamentals, not from the thesis being wrong, but from the volatility itself. In a parabolic move, price does not go up in a straight line. It never does. It goes up $10, crashes 5, goes up 12, crashes 7, goes up 15. These violent swings, these whipsaw moves, they are designed to liquidate leverage traders. They are designed to shake you out of your position before the real move happens. The banks know where your stop losses are. They can see them. They have access to the order book. They know exactly what price will trigger a cascade of forced selling. And in thin liquidity, in the middle of the night when volume is low, they will hunt those stops. They will spike the price down just far enough to trigger your liquidation, and then they'll let it rip back up. We saw this last week. December 31st, the crash to $70. If you were on margin, you got wiped out. Your position got liquidated. You were forced to sell at the absolute bottom. And then you watched, helpless, as it rallied 30% over the next 3 days. You missed it, not because you were wrong about the direction, but because you were using leverage. Do not let that happen again. Do not let a 10% pullback destroy your position when you're right about the 100% move. The strategy for this phase is simple. Deleverage. If you have massive paper profits right now, if you bought at 65 and you're sitting on gains, take some off the table. Not all of it, some. Convert 20% of your position into physical metal, coins, bars, something you can hold, something that can't be liquidated by a margin call. Take another 20% and move it into fully paid mining stocks. No margin, no options, just shares, paid in full, so that when the inevitable pullback comes, and it will come, you're not forced to do anything. You can sit on your hands. You can wait. You can watch the panic sellers gift you their positions at discount prices. The goal is to be unshakable. The goal is to structure your portfolio so that a 20% drop does not force you to act. Because the only way to ride a bull market to its full potential is to make sure you can't be bucked off halfway through. Let's talk about circuit breakers. So this is something most retail traders have never experienced. But with the momentum we're seeing, with the buying pressure building, there's a very real possibility that we hit limit up this week. Limit up means the exchange halts trading because the price moved too far, too fast. It's a safety mechanism. It's supposed to prevent panic and give the market time to cool down. When silver hits its daily limit, the screen freezes. The price stops updating. You can't buy. You can't sell. You just wait. If you wake up tomorrow morning and the silver market is frozen, do not panic. Do not call your broker in a frenzy. Do not try to sell on some secondary market or peer-to-peer platform at a discount. A limit-up halt is the ultimate bullish signal. It means there are no sellers. Zero. It means every single person who owns silver has decided it's worth more than the current price. It means the market is trying to find a new equilibrium that doesn't exist yet. And when that happens, when trading resumes, the price almost always gaps higher again. If you sell during the panic of a halt, you're giving away your position for pennies. You're selling to the smart money who stayed calm. You're becoming exit liquidity for the very people who caused the halt in the first place. Sit on your hands. Let the market clear. Let the system reset. The exchange is trying to cool things down, but you can't cool down a volcano. You can't stop a tsunami. All you can do is ride it. Here's another survival rule. Ignore the noise. Starting today, the financial media is going to go insane. You're going to see headlines screaming about bubbles. You're going to see analysts calling for crashes. You're going to see talking heads on TV saying silver is overvalued, overbought, overextended. They said the same thing at $50. They said it at $60. They said it at $70. They'll say it at $80 and $90 and $100. They're always wrong at turning points because they're looking backward, not forward. They're analyzing the move that already happened instead of the move that's coming. Turn off the TV, unfollow the permabears, stop reading the comment sections. The noise will only confuse you. The noise will only make you second guess yourself. You did the research. You understand the fundamentals. You know why this is happening. Trust your analysis. Trust the plan. But here's the hardest part. The part that separates the amateurs from the professionals. You need to manage your emotions. Fear and greed are going to war inside your head right now. Every tick up, greed whispers, buy more. Every tick down, fear screams, sell everything. Both are lying to you. The truth is somewhere in the middle. The truth is boring. The truth is, stick to the plan, manage your risk, and let time do the work. If you're feeling euphoric right now, if you're convinced this is going straight to 200 with no pullbacks, you're too bullish. Take some profits. If you're feeling terrified, if you're convinced the next crash is coming and you'll lose everything, you're too bearish. Add to your position. The right emotional state is calm confidence. Not excitement, not fear. Calm confidence. And one more thing, do not tell everyone you know about this. Do not become the silver evangelist at every dinner party. Do not post your positions on social media. The more you talk about your wins, the harder it becomes to hold through the inevitable pullback. Because when that pullback comes, everyone who listened to you will be asking, what happened? I thought you said it was going to the moon. And that social pressure, that need to defend your thesis to people who don't understand it, will make you sell at the worst possible time. Keep your mouth shut. Keep your head down. Let your account balance do the talking. We need to address the elephant in the room. The question everyone's asking but nobody wants to say out loud. What if this is the top? What if $75 is as good as it gets? What if we're buying into the final blow-off and tomorrow we crash back to reality? Let me answer that question by showing you what's different this time. Because every bull market has skeptics. Every rally has people calling it a bubble. And sometimes they're right, but not this time. And here's why. In 2011, when silver hit $50, it was a speculation bubble. It was retail investors piling in based on fear and momentum. There was no institutional involvement. There was no physical shortage. The fundamentals were weak. It was purely sentiment driven. And when sentiment shifted, it collapsed. This time is structurally different. This isn't retail driven. This is institution driven. This isn't speculation. This is allocation. Pension funds don't buy bubbles. Sovereign wealth funds don't chase memes. They buy assets they need for the next decade. The demand we're seeing now is inelastic. China needs silver for manufacturing. They can't just decide to use less because the price went up. The solar panels still need silver paste. The EVs still need silver contacts. The 5G infrastructure still needs silver components. The demand is baked in. It's non-negotiable. And on the supply side, we're not in a surplus anymore. For the first time in decades, we're running a deficit. The world is consuming more silver than we're mining. Every single year, the gap is being filled by above-ground stocks, by recycling, by draining inventories. But those inventories are finite, and they're running out. When you combine inelastic demand with declining supply, you don't get a bubble. You get a structural repricing. You get a new equilibrium at a much higher level. That's what we're witnessing, not speculation, scarcity. But let's play devil's advocate. Let's imagine the worst case scenario. Let's say the Venezuela situation de-escalates. Let's say China's economy slows and their industrial demand drops. Let's say the banks coordinate one more massive smash to shake everyone out. What happens? Even in that scenario, we have a floor, and that floor is much higher than where we were 6 months ago. Why? Because the pension funds are here now, because the institutional allocators have made their decision. They're not swing trading. They're not going to panic sell on a headline. They bought for portfolio diversification, for inflation protection, for strategic allocation. They're holders. So the worst case isn't a crash back to 50. The worst case is a correction to 65, maybe 60, a consolidation, a digestion of gains, and then the next leg up. That's how bull markets work. They don't go straight up. They climb stairs, 2 steps forward, 1 step back. But the trend is clear. Here's what you need to understand about this phase of the market. We are no longer in the accumulation phase. That was 2023 and 2024. We are no longer in the early breakout phase. That was November and December 2025. We are now in the acceleration phase. This is where things get parabolic. This is where the moves become violent and unpredictable and emotionally exhausting. The acceleration phase is characterized by gaps, by limit moves, by headlines, by FOMO, by late-stage buyers piling in, by shorts capitulating, by institutions chasing. This is the phase where fortunes are made and lost in days, not months. And here's the brutal truth about acceleration phases. Most people don't make it to the end. They get shaken out. They sell too early. They buy back in at higher prices. They panic during corrections. They overtrade. They use too much leverage. They make emotional decisions. And they turn what should have been the trade of their lives into a break-even or a loss. Don't be most people. You know what's coming next, right? After acceleration comes euphoria. That's the final phase. That's when your taxi driver is giving you silver tips. That's when CNBC has silver tickers running 24/7. That's when new ETFs launch. That's when celebrities tweet about it. That's when your mom calls asking if she should buy. That's when you sell. Not now, not at 75, not at 85, but when the world has finally figured out what you knew 6 months ago. When the secret is no longer a secret. When the trade is crowded and obvious and everyone agrees. That's the exit. We're not there yet. Not even close. The average person still thinks silver is just for doomsday preppers and conspiracy theorists. The average financial advisor still allocates 0% to precious metals. The average portfolio still has zero exposure. When that changes, when silver becomes mainstream, that's your signal. But let me give you a framework for thinking about this that removes emotion from the equation. Think of this market in quarters. Q2 brings earnings, season for mining companies, massive profits, huge cash flows, dividend increases, stock buybacks. That brings in the equity investors. That takes us to 100, maybe 110. Q3 brings summer driving season, increased industrial activity, solar installation peak season. That brings supply pressure. That takes us to 120, maybe 130. Q4 brings year-end positioning, political uncertainty heading into 2027, and the next wave of institutional rebalancing. That's when we test the highs. That's when we potentially see the blow off top. This is a year-long trade, not a week-long trade, not a month-long trade. If you're trying to day trade this, if you're trying to catch every swing, you're going to get chopped up. The professional approach is to build a core position and hold it through the noise. Add on major dips, trim on extreme spikes, but keep the core intact. Think like an institution, not like a gambler. We've reached the end, the final chapter of this investigation, and now it's time to bring it all together. Time to give you the clear, unfiltered verdict on what you're witnessing and what you need to do next. January 5th, 2026 will be remembered. Mark it in your calendar. Circle it. Because this is the day the silver market broke free from 40 years of suppression. This is the day the control mechanisms failed. This is the day the real price discovery began. The war premium is real. Venezuela wasn't just a headline. It was a catalyst that reminded the world that resources are finite, that geopolitics matters, that when superpowers mobilize, safe haven assets explode. Silver absorbed that fear. It priced in the uncertainty. And it did exactly what it's supposed to do during times of global tension. It protected wealth. The Shanghai Vacuum is real. The $5 gap between New York and China isn't a glitch. It's not temporary. It's structural. It's the market telling you that physical metal is worth more than paper contracts. It's the East, draining the West of strategic resources while paying a premium that the Western markets refuse to acknowledge. That gap will close. But it will close by New York rising to meet Shanghai, not the other way around. The bank trap is real. The shorts are bleeding. The risk models are flashing red. And the forced covering is creating a feedback loop that feeds on itself. Every buy order from a panicked bank pushes the price higher, which forces the next bank to cover, which pushes it higher still. This isn't going to stop until they're all out, until every single short position built during the suppression era has been liquidated. The pension fund wave is real. $50 trillion of institutional capital is looking for a home. And a tiny fraction of that capital, just a sliver, is enough to overwhelm the entire silver market. They're not trading. They're allocating. They're not speculating. They're building portfolios for the next decade, and every ounce they buy is an ounce that leaves the market forever. These four forces, geopolitics, arbitrage, short covering, and institutional demand, have converged at the exact same moment. This doesn't happen by accident. This doesn't happen often. This is what we call a perfect storm, and we are standing right in the center of it. But here's what you need to understand as we close this chapter. This is not the end. This is the beginning. $75 is not the destination. It's the starting line. The breakout above 75 confirmed that the bear market is over. The consolidation is over. The suppression is over. We are now in a new regime, a regime where silver is repricing to reflect its true value as both a monetary metal and a strategic industrial resource. The target is not 80, it's not 90, it's not 100. Those are just milestones along the way. The real target is determined by how much currency they have to print to keep the system alive. It's determined by how much demand industry generates. It's determined by how long it takes for supply to respond. And right now, all three of those factors point to a much, much higher number than anyone is publicly willing to admit. But getting there requires discipline. It requires patience. It requires emotional control. You cannot day trade your way to generational wealth. You cannot leverage your way to freedom. You build wealth in markets like this by doing the boring thing, by buying quality assets, by holding through volatility, by ignoring the noise, and by selling only when the world finally agrees with you. Your job for the rest of this week is simple. Watch the $80 level. When we break it, and we will, watch how the market reacts. Does it consolidate? Does it pull back? Does it rip straight through to 85? The behavior at 80 will tell you everything you need to know about the strength of this move. Watch the ETF flows. Watch the vault inventory numbers. If SLV sees massive inflows but the physical holdings don't increase, you'll know the banks are scrambling. You'll know they can't source the metal, and that's your confirmation that the shortage is real. Watch the mining stocks. When the juniors start going vertical, when the exploration companies with no revenue start doubling and tripling, that's your signal that we're entering the euphoria phase. That's when you start thinking about exits. Not now, but watch for it. And most importantly, watch yourself. Watch your emotions. Watch your account balance. Watch for the moment when you start feeling invincible. Because that's when you're most vulnerable. That's when you make mistakes. Stay humble. Stay disciplined. Stay focused. This is the trade you've been preparing for. This is the moment you saw coming when everyone else was laughing at you. When they called you a conspiracy theorist, when they said silver was a barbarous relic, when they said the banks would never let it run. Well, look at your screen. The banks lost control. The price is running. And you were right. But being right means nothing if you don't execute. It means nothing if you panic out during the first pullback. It means nothing if you over-leverage and get liquidated. It means nothing if you sell at 80 because you're afraid it's the top. The path forward is clear. Hold your core position. Add on weakness. Trim on extreme strength. Watch the gold to silver ratio. When it hits 30 to 1, make your first swap. When it hits 15 to 1, make your final swap. And when the dust settles, when the cycle is over, you'll have transformed your silver position into a gold position 3 times the size. You'll have turned a trading opportunity into a legacy. This is not financial advice. I'm not a licensed advisor. I'm just someone who's been watching this market for years, who studied the patterns, who understood the fundamentals, and who's sharing what I see. You have to make your own decisions. You have to do your own research. You have to take responsibility for your own capital. But if you've made it this far, if you've watched this entire investigation, if you've absorbed every word, then you understand something that 99% of investors will never grasp. You understand that we're not just witnessing a price move, we're witnessing a wealth transfer from the unprepared to the prepared, from the paper holders to the physical holders, from the West to the East, from the banks to the people. And you're on the right side of it. The war candle is lit. The perfect storm has arrived. The greatest repricing event of your lifetime is underway. Don't blink, don't panic, don't sell too early. This is your moment. Make it count. If this investigation opened your eyes, if it gave you clarity, if it helped you understand what's really happening in the silver market right now, then do 2 things. First, subscribe to this channel so you don't miss the next update, because this story is far from over. And second, share this video with someone who needs to see it. Someone who's still asleep, someone who's still holding paper while the world burns. The information is out there, but only for those willing to look. Thank you for watching. I'll see you in the next one.